In today's video, I'm going to show you how to make $700 daily using the poor man's covered call strategy on QQQ. So if you're looking to boost your income or looking for a way to replace your full-time salary, then this video is for you. Hi, my name's Gautam. I'm a former finance executive turned options trader. My goal is to help you escape the 9 to 5 grind like I did with the power of options trading. A quick disclaimer before we get started. The information provided in this video is for educational and informational purposes only and should not be considered financial advice. I am not a licensed financial advisor. Now, let's jump in the actual strategy. The poor man's covered calls are a variation of the traditional covered call strategy. So in a standard covered call, an investor would own shares of a stock and sell call options against those shares to generate income. In contrast, or in this case, a poor man's covered call involves purchasing a long-term call option, also known as LEAPs, instead of buying the actual stock and then selling short-term call options against those LEAPs. What are the components of a poor man's covered call? So, as discussed, the LEAPs, these are the options with expiration dates typically extending beyond a year. They provide the exposure to the underlying stock at a fraction of the cost instead of owning the share. Short-term call options, these are the options with shorter expiration dates that are sold against the LEAPs to generate the income. The goal for these options is to expire worthless, allowing us the investor to keep the premium collected from selling them. Next, let's discuss how we would execute this strategy to bring in the $700 daily income on the QQQ. First things first, we want to purchase our LEAP options. Once you're ready to purchase the LEAPs, you want to focus on deep in the money LEAPs with the delta between 70 to 80. For example, QQQ is currently trading at 497.66 as of end of day 3/13/25. Now I'm recording this video on Sunday, March 16th. So based on Friday's pricing, you could go down and select the 450 strike price, January 16, 2026 LEAPs for about $66 a contract. That would be about 70 delta. You could also go over and purchase the March LEAPs, which would cost you $70 per contract. So let's say you go forward with the January 2026 LEAPs. Buying 10 LEAPs would cost you $66,000. That is $60 per contract times 10 LEAPs. If you decide to go with the March LEAPs, $70 per contract times 10 contracts would cost you $70,000. This will let you control 1,000 shares of QQQ or 10 option contracts. For the next step, to collect $700 in premium, you will need to sell 10 short calls against your LEAPs daily. Assuming the QQQ end of day price of 479.66 as of 3/13 Friday, you could sell the 3/17 next day LEAPs at a strike of 485 and collect a premium of $700. Now, if you want to play even safer, you could choose a lower delta of 15 and sell the next strike price of 486. For selling the 486 calls, you would collect a premium of $520 for your 10 short calls. Now, let's move over to Robinhood and see how we would conduct this transaction in real time. So first, we want to go ahead and buy our LEAP options. So you would select QQQ, then buy, call. Go ahead and select January 16, 2026. That's about 306 days out, almost a LEAP, or 365 days would be actually considered a LEAP. So you could choose either the January 16, 2026 option, or if you want to go slightly over a year, you could choose a March 20, 2026 option, which would cost us just a little bit more. So assuming we go forward with the January 16, 2026 option, we would come down and choose the 450 strike price right here. This is about the 70 delta that we were targeting. It's actually 71, so even better. You would go ahead and select this option right here. You would hit continue. And we want to go ahead and buy 10 of these. So about 66,000, like we discussed earlier in the slides, is what we would pay to buy these options. Next, you want to come back and sell your 10 short calls against the leaps. So you would come back to QQQ, go ahead and select sell call, and then choose the next business day. I'm recording this video on the 16th, so the next business day would be March 17th. Come down and choose a delta of 20, which is 70 cents per contract. Go ahead and hit the plus button, hit continue, and you would make this 10 right here. And this would give you a premium of about $700. You could also play it safer if you like and go with the higher strike price. If you go up one strike to the 486, this would give you about 52 cents in premium. So for 10 contracts, that would be $520. Now let's do a quick recap and run some numbers. If you were able to do the strategy successfully 4 times a week, you would make 700 times 4. That's $2,800 a week, or about $11,200 a month. Now that is a return of investment of about 17% monthly, which is fantastic. Or that turns out to be 204% annually versus an average return of 10% with the SPY. So if you make $11,200 per month, you could pay off your leaps in only 6 months and enjoy the daily premium for the remaining 6 months. You would also make additional profit from holding your leaps and selling them when you achieve your desired profit target. Next, let's talk about some risk management tips which are essential to help you manage your position. So first things first, you want to take profits on your leaps as soon as you hit your profit goals. Now, the profit goals will vary depending on person to person. One person may be happy at 20%, or for another person 30% or 50% is what they're targeting. Considering the markets can reverse at any time, you should lock your profits when you see the green. Again, as soon as you hit your profit goal, whether it's 20%, 30%, or 50%, I would go ahead and lock that profit and take the gains, and then simply re-enter the position again at an ideal time and repeat the process. If the markets drop as soon as you enter your leaps position, you could roll down your strike to a lower strike price to be even safer if you have additional capital to allocate. If you are in your leaps with less than 6 months to expiration, consider rolling the leaps out to reduce theta decay and maintain a long-term position. And finally, and most importantly, you do not want to lose your leaps when selling the short calls. So if the stock price rises significantly above the strike price of your short calls that you are selling daily, you should roll your short calls out to a future date with a higher strike price, or even buy them back at a loss to avoid losing your leaps. Remember guys, the goal is to not lose your leaps. So don't worry about buying back your short calls at a loss. Your goal again should be not to lose your leaps and have them called away. I hope you found this video helpful, and if you did, don't forget to give it a thumbs up, share with your friends, and subscribe to my channel. Also, don't forget to click on the free options newsletter link in the description below, where I share my tips, tricks, and strategies with all of you. Thank you, and I'll see you in the next one.